Welcome to the McAlvany Vault, where we revisit classic shows and highlights from 2008 and on. While you're listening, remember to thumb this video up, share with your friends, and leave a comment or question down below.
This is beyond anything we've seen. This is trying to save the Fed and the Treasury. I mean, they're all in. They're betting their, not just reputation, they're betting their structure, their mission. But more importantly, you're betting the U.S. political, welfare state crony capitalist system. This is beyond anything we've seen. This is trying to save the Fed and the Treasury. I mean, they're all in. They're betting their, not just reputation, they're betting their structure, their mission. But more importantly, you're betting the U.S. political, welfare state crony capitalist system. That's why this is such a vicious fight. That's why they've already spent trillions and they've backstopped most everything with tens of trillions, because this is all in. You're betting the Roosevelt-era U.S. economic, financial, and political system. It's an enormous bet.
Yeah, it's probably the biggest ever as far as the Fed is concerned, certainly.
Absolutely.
But there's more at stake if you're looking at the current administration. Everything's on the line in terms of a re-election, even the midterm elections this next year.
Well, Bill, one of the things that you've brought up, and we've talked about actually on this show the last few weeks, is the incredible amount of the disparity in insider selling, the corporate executives that are having to report their sales. Right now, I think it's running $31 of insider selling to every $1 of buying. So it's obviously the guys who actually are seeing the numbers, who are seeing the accounting of their own firms, they're not casting a vote of confidence, but this market is still holding up. What would you attribute to the volume coming into the market right now?
Well, there isn't much real volume. I mean, most people are showing that this has been a low-volume rally, which is why I suspect. But again, this is a rigged volume, and a lot of this volume is professional trading. The high-frequency trading, the quants, whatever, and that really perverts the volume totals. If someone shows up with 1 million shares, the buyer of that 1 million shares is an algorithm, and they're piecing it in or whatever, that probably turns into a multiple. That might turn into 2 or 3 million shares because of all the traders buying in front of them and flipping it for a penny or two with the high-frequency trading. So even though you see the volume a lot of times that show up in here, real orders, the real institutional orders are far and few out here, and this is really professional trading. That's why it's light volume. That's why they can whip the market all over, because most people are standing on a sideline because they don't know how this is going to play here. So it is a difficult environment. Now, what the insiders see, the people running companies, they see the businesses are bad even with all this government stimulus. The thing is actually incredible, you think. If you think about the trillions of dollars that have been spent, the tens of trillions earmarked, the nationalizations, and then all you can get out of people is, well, the economic data is less bad. That makes it good. Now, wait a minute. This is the equivalent of somebody having a massive heart attack, losing almost all their blood, and the expectation is they're going to get up and run the 4-minute mile here, and the guy, well, he's not as bad. I mean, when you think about what's been thrown at this market, and this isn't even a half-full, half-empty glass argument. This is unprecedented what they've thrown at this market. And they're barely keeping this stuff going, and they will not take the umbilical cord away. You see that in all the Fed minutes, whatever. And the reason is, beneath the surface, there's a lot of segments of the economy are worsening. What we're doing because of this welfare state crony capitalism, they're saving all the big guys. But I just got back from Texas this week. I'm talking to a land developer, guys, does a lot of business in the Houston area, a lot of development, also does surveying and engineering. And they've been okay. They haven't got hit like the rest of the country, but what's going on down there is very interesting is they have viable projects where a bank, one of the ones that was rescued, was forced into some other bank, is demanding they put up more equity. And they're like, why? We're viable. Are you doing this to other developers? And they wouldn't respond because another developer who also was a banker, they checked around, they found out what's going on is the banks, because so many other people are busted, don't have money, they're going back to people that they don't have capital and are trying to extract capital. On the other hand, I do the bank portfolio for a banking group here in the Illinois area, and it's a community banking group. They've been getting squeezed for months. The regulators are hammering these guys. I've been trying to put all these articles in the letter about that. So on the one hand, they're telling the select few banks, we'll give you all this money. You don't have to mark to market. You don't have to reserve against these busted banks we're taking. And then they're just absolutely hammering these other banks. They're making them aggressively write off properties. They're all over them. And as I said, in the letter, if you didn't know better, you'd think part of the strategy was to force these guys out of business so the big guys have less competition. So that's the other side of this. I don't know how many people you've talked to where no problems, and all of a sudden they're getting credit card limits cut. They're getting home equity lines cut. But on the top end, they're just throwing at the chosen few companies or banks, whatever, they're just throwing enormous amounts of money. And this is not good. You see it in the consumer credit contracting. You see it in bank lending contracting. You see it in the slowdown in the monetary aggregates. No matter what monetary aggregate you want to pick out, the growth is slowing. Some are even falling negatively. Yet the Fed keeps creating credit for a select few. It's not getting into the system. Now, where's it going? It went into stock prices. The money went into some commodities. But it's not getting into the economy, and that's what the insiders see. And they don't think it's going to get in there because the one thing that's going on in this country, and it's been going on for decades, except for that period in the 80s, is the U.S. real wages and living standards have been declining. And they've been hiding it with BS government statistics, particularly about CPI and GDP and jobs. There's over 4 million job discrepancy between ADP small business and the BLS's business birth death model since January of 2008. Now, that's a lot of jobs and income that they have a discrepancy about. ADP said 2.5 million jobs have been lost in the small business jobs, and BLS thinks 1.5 million and change have been created. Well, that's a huge discrepancy. And this is what the guys in industry sitting in a chair seeing their business see what's going on. At Wall Street, the stock market doesn't reflect the economy. It hasn't for years. For all the people talking about, well, we have a Dow theory buy. Well, you know what? The transportation average, Dow theory's transportation made an all-time high in, July 2008? We were already several months into recession. So how did it miss that? What kind of forecasting tools, if it missed the worst recession since the Great Depression? And then 2-3 months later, the whole U.S. economy financial system was at the abyss. How good of an indicator is the stock market? Over the last decade and a half, the stock market has gone from a gauge of economic activity to an instrument, to another asset bubble as an instrument to generate economic activity. And that's the big difference. It's a totally different game now.
It seems there's a real irony between the course that's being chosen by the Fed and the Treasury, quantitative easing, the massive creation of money and credit, and where it's going. Certainly, if you listen to Obama, he's of the notion that the man on the street is going to be the beneficiary, and all the changes that are being made, whether it's to protect and preserve well-being or whether it's the Cash for Clunkers program. The insinuation is that all of this is being done for the man on the street, and yet, as you mentioned, consumer credit fell apart. $21.6 billion in July, 5 times as much as forecast. That's the contraction in consumer credit.
Right.
If our economy is based, what was the recent high, 73% of GDP based on consumption? And it's going away. It's going away. So what does that spell? I mean, as you start to describe a liquidity-driven crack-up where the Dow and the S&P move up not on the basis of their own merits, but on the basis of a Fed and Treasury-induced liquidity push, how is that actually? I mean, it seems to me to be nothing more than a microcosm of what you'd see in hyperinflation, where actually the Dow and the S&P could go to 30,000, 40,000. The question is, what does that actually mean in real terms?
It doesn't do anything in real terms. The reason hyperinflation is so bad is you destroy the middle class and the merchant class. Because of this, they can't hedge, they can't move around fast enough with their businesses, and they can't move their wealth around, and that's the difference between the U.S. and everybody else in the world, is that we have this merchant class, middle class, mom-and-pop businesses that generate 70% or even higher of your jobs, and you destroy them. That's the problem when you start doing the funny money. What we've done here for decades is the slow, methodical inflation. And that's what stocks like. Stocks like slow, methodical inflation. That's why stocks outperform gold in that kind of period, because companies can pass the cost on better, they have better leverage. Gold gets excited in either serious deflation or when people fear the inflation is going to grow fast enough that the merchant class can't keep up with it, and that's what's going on now. Again, it's this outgrowth of Keynesianism where we can always paper over our problems. And we've been doing it for so long, they think they can keep getting away with it. And, I mean, that's the bet now, that they can keep getting away with this stuff. And, you know, when you look at the math, there's no way you're going to pay this debt. There's no conceivable way. So you got two choices. You either paper it away, try to paper it away, or you're going to default on it. And this is the one argument, all the people that want to say, well, we're going to hyperinflate. I said, based on what? Like, well, look at Zimbabwe. I go, you really want to compare Zimbabwe? And they go, oh, no, you can't, but look at Germany. I go, okay, fine. That's one instance. Look at all the other people, especially recent history, post-World War II, that have gotten in the problem with too much debt. How many of them have run hyperinflation? None. What has happened, though? They default.
Germany was different, too, in that they lost their access to the capital markets outside of their own country.
Exactly. Right. And there were some other things going on, too, there with England and France because of the World War I debt. Now, debt, in some ways, you say you can equate the U.S. here, but the recent history is you default on the debt. You try to paper, and that's what happened. They try to paper over it. Now, the other interesting thing with the hyperinflation is it's back to Ben Bernanke citing Milton Friedman's helicopter speech. We can run the printing press and drop the money. You can't. It's too expensive. You can't. The cost of, create currency, the logistics of dropping it, you can't do it. So they're trying to create this by electronic transfer. The big difference between the Great Depression and even Weimar and what's going on now is the reason we have not had bank runs like we had in the 30s is because in the 30s you didn't have credit cards. If you want to get on the streetcar to go to work or buy lunch or buy milk for your family or whatever, you have cash. You don't need that now. We don't have a lot of cash in the system. We got, about $900 billion or less cash against tens of trillions of wealth and debt. So that's why, as long as the credit here, as long as you can keep throwing your plastic around, you don't have the bank runs like we had in the 30s because it's a totally different dynamic. But that makes it a little difficult for the hyperinflation to take effect because with cash, you print up, you put it out. First, we're not used to doing it. We don't have the stream to do it. But the other point is the Fed's trying to inflate. I mean, they're clear that they're trying to inflate. But that money's only going into a handful of pockets. We know all the names, whether you want to say Goldman, AIG, GM, GE, Citi. They're getting the money. The community banks aren't. The small businesses aren't. You're not getting that credit. And that's what all the statistics show. That credit is not getting into the system. If you drop cash, it would get in because people would spend it. But the banks are not putting that credit out. So that's why it's so tricky. And again, I said the path isn't clear here between are you going to get significant inflation or are we going to finally take the debt deflation? Not a clear path. Not a clear path. And that's why this is such a difficult process right now.
Well, it brings us back to where we started talking about the Chinese and how critical over the next 3-4 weeks the maneuvering is geopolitically into our own markets. These are strategic moves. The renminbi bond market was launched just in recent weeks. The Financial Times ran an article on that last week. You've got mainland states-sponsored television promoting gold ownership and silver ownership amongst private citizens. Hong Kong is pulling all of their gold from depositories in London and foreign because they want control of the asset itself. They don't want a claim. They don't want a paper promise. If it's gold, they want it in their physical possession. And as we mentioned earlier, you've got paid in renminbi rather than dollars, the first purchase of $50 billion in IMF bonds. Any one of them on their own is a pretty big deal. Taken in tandem in a 2-week period says that, you do have some serious poker going on, and between the two parties, between our Fed and Treasury and between their monetary authorities, they're willing to start throwing down 50 billion chunks to say, we're calling your bet.
We're all guessing, and we're trying to guess where's China's tolerance. It's just like the politicians in this country have played this game. We're going to keep creating deficits, and we'll keep borrowing money, and they've been able to get away with it. But this is what this crisis was about, that it's, like Margaret Thatcher said, the problem with socialism is eventually you run out of other people's money. Well, we're out of money. We've been out of money for a long time. And we all know the problem. The problem is benefits and living standards that our production doesn't support, and we've been going into enormous amounts of debt to support it. The solution that they're giving us is go into more debt for more consumer spending, gratuitous, expedient, just like GM did in the early part of this last decade here with the zero financing, selling cars at losses just because they're a union contract. They were going to lose money if they produced no cars, but they lost less money if they produced cars at a loss. And I remember writing, and other people did, is you're cannibalizing future sales, and you're going to go bankrupt doing it. Well, they did. And now the solution is we'll cannibalize even more of the future for some gratuitous, expedient consumerism, and we'll go into more debt. Until you see real restructuring of the U.S. economy and political system, you won't have a real bottom. You're just not going to get it. People want to compare 1982 to what happened now. That's not even close. We had enormous change. We moved from an inflationary paper-over economy to a real production, Volcker driving the inflation out of the system, Reagan running the economic war against the Soviet Union, which also drove inflation out of the system, unleashing capitalism. We had the biggest boom in job creation since decades in the 80s, and it was the biggest boom ever for women, minority, and small business. That's what you have to do again. We know it has to be done, but it doesn't go with the political agenda. And that's why we're having the problem. And that's what Joseph Stiglitz, the Nobel Prize winner in economics, said. We have worse problems now than we did a year ago because of all the things you're doing, all the papering over. You're making failed banks that were too big to fail even bigger, and you haven't resolved any of their problems. And until we get the true restructuring, it's just more of the same, more of what we've been doing, create another asset bubble to paper over the problems, have it blow up, throw more money. Where does it end? Nobody knows. Nobody knows where this thing finally, you just come in and, the dollar, the bond market, whatever, is saying, you know what, that's that. You can't do that anymore. But that's the big one to watch, the bond market. One of the things that is going on that people don't understand with these unnaturally low interest rates is this is, again, the crony capitalists and the welfare state taking money from savers. They're appropriating money from savers and giving it to people that have blown themselves up. And I went out of my mind last week when the vice chairman of the Fed said, well, we followed Walter Bichat's prescription for crisis. And I went out of my mind because they totally violated. And this was the guy, kind of the father of central banking in the 19th century in England. And he said, when you have crisis, you lend liberally on good credit, on good collateral, at a penalty rate to solvent institutions. Excuse me? First, how many insolvent institutions did these guys bail out? Second, penalty rate, they drove it to virtually zero. Collateral, they accepted junk. They said, give us the stuff nobody else will buy. And this guy has the nerve to say we followed. The only thing they followed was lend liberally. But this is what you get out. You get this stuff put out all the time. Oh, no, we're not monetizing debt, but we're doing quantitative easing. Please. But again, because the reason this is going on, all the subterfuge, all the lies, the deceit, the duplicity, is because the stakes are so enormous.
With the stakes as high as they are and people focusing more and more on asset preservation, not really even caring the classic phrase of worrying more about the return of their capital rather than the return on their capital. Is there a strategic allocation that makes sense? Not a traded position, 10-day, 2-month allocation, but, we just need to see where the dust settles, and then we can make intelligent choices from that point forward.
You are absolutely right. You just can't get out here and say, we're having deflation, we have inflation. You can't. Nobody knows. So I think you have to keep some kind of cash reserve. There's no question, because if you get to debt deflation, you need that. At the same time, you have to hedge your dollar risk. And there's a number of ways to do it. Part of it is, in fact, you're seeing some of the big reason for the stock rally here is a lot of private wealth saying, I got to grab something. And part of it's gold. It could be oil. I would say farmland, I think, is an excellent choice in here. Some of these type of property, I think premier properties, oceanfront real estate, definitely not condos in downtown areas or some of these areas, but there's certain good properties and whatever that I think you can hide money in, and just what you're saying. It's not so much the return, but I know it's going to exist. Unfortunately, because we're dealing with this crony capitalist aspect of what's going on here. Is everybody's looking at, should I buy GM or GE or the big companies or JP Morgan? But what they're missing is and I know some people that are doing this, they're missing the smaller entities that are out there. The thing you have to ask yourself is what kind of businesses are going to exist no matter what happens, whether we have hyperinflation or some type of inflation or debt deflation. Who's going to exist? And again, like farmland, body shops, pharmacy, the pharmacies are difficult because until we know what the healthcare plan looks like, but that's what you have to start thinking about. Vital services, vital businesses that are going to exist no matter what happens, and you can't be leveraged. That's the problem. Now, when the inflation takes hold, then you can go with everybody else. If you get the credit, you leverage. But in the meantime, if you got cash and you look for vital industries, that's where you should be hanging out until the stuff starts clearing up a bit.
Well, Bill, we thank you for joining us today, and look forward to your insights here in the future as well.
Bill, we've been reading your material for many, many years. I know it's been a favorite staple here at McAlvany's, and I know that our clients have enjoyed it too when you sent the standard packet. Is there a way that the new listener can contact you to see what your material encompasses?
Sure. Please drop us an email at kingReport@ramkingsec.com. That's King, K-I-N-G, report, R-E-P-O-R-T, at RAM, R-A-M, King, like my last name, K-I-N-G, S-E-C, as in securities.com. No dot, dashes, underscores.
All right, very good. Yeah, and feel free for any of our listeners to contact Bill King and check it out. You seem to be very much ahead of the curve, and like I said, we really appreciate your information.
Well, thank you very much.
Well, you've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany and our guest today, Bill King, author of the Daily King Report. You can find us at McAlvany.com. That's McAlvany.com. Or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.